Hi guys, I'm Kisal De Silva. I'm ready to take you all on a meaningful conversation. First of all, I would like to get a start on our conversation. So I'm ready to define the topic of today's conversation. Financial markets. Financial markets are the marketplace where the financial instruments like bonds, stocks, currencies, and commodities are traded. These markets facilitate the flow of capital from savers to borrowers, enabling businesses to raise funds, government to financial projects, individuals to invest and gain their wealth. These markets are crucial for economic growth by allowing efficient resource allocation and liquidity. So there are several types of financial markets: bond market, stock market, capital market, money market, commodity market, foreign exchange market, etc. Today we are going to talk about capital market versus money market. In the class there are my campus colleagues, so we have a conversation with them. So let's go. So let's get some information from our classmates about capital market and money market. This is my mic, so let's be a trouble for our classmates. Hi Roshina, can I ask a question from you?
Yes.
What do you know about capital market?
Is it serious?
Yes, it's a YouTube video.
Come, I will explain the capital market. Capital market is a financial market where the buyers and sellers engage in the trade financial securities like shares, bonds, and other investment. It serves as a platform for the companies and the government or other institutes to raise the long-term funds. Capital market can be categorized into two main parts: primary market and the secondary market. Primary market is the place where the buyers and sellers sell the new shares or bonds to the first time to raise the money. And the secondary market is the place where the buyers and sellers sell the shares or bonds that are already issued.
So we get information about capital market. Thank you, Roshina. Now we're going to talk about money market. Hi Dinwara, can I ask a question from you about money market? Are you kidding me?
Now we talk about money market. Let's go. Money market. The money market is a key part of the financial system, where individuals and institutions borrow and lend money for short term, typically less than 1 year. These are the key features of the money market. Short term lending and borrowing. It means deals with money less than 1 year. Low risk. It means safer than stock markets because it involves short-term and secure instrument. Highly liquid. It means investment can be quickly turned into cash. So these are the participation of money market: central bank, finance companies, money markets, and individuals. These are the instruments of money market: treasury bills, commercial papers, and certificate of deposit.
So now we talk about differences between capital and money market. I invite two friends to discuss about that. They are also different in height. So let's move to capital market versus money market.
Hey David, do you know about money market?
Yeah, why not? Money market is short. It means financial instruments mature in less than 1 year. So, Yasinta, do you know about capital market?
If money market is short term, definitely capital market is long term.
Yeah, you are correct.
So money market has informal nature.
But the capital market has formal nature.
However, money market has low risk rather than invest in the capital market.
But the capital market give higher return on investment.
But liquidity is high in the money market.
Yeah, in capital market liquidity is comparatively less.
But in money market, fulfill short-term credit requirements like provide working capital.
In this case, capital market fulfill the long-term credit requirements of the company like providing fixed capital to purchase land, building or machinery.
However, when look at the financial instruments, treasury bills, commercial papers, certificate of deposit, those are the financial instruments in money market.
So, shares, debentures, bonds, retained earnings, asset securitizations, those are financial instruments of capital market.
However, both markets are very important to financial sector.
Today, you all are here with conversation in financial markets. This is the end of our conversation. So today we talk about capital market, money market. At the last, we discuss about money market versus capital market.
Capital market versus money market.
A financial market is a marketplace where people and organizations trade financial instruments like stocks, bonds, currencies, and derivatives. It enables institutions to access financial services, raise capital, support government projects, and provide investment opportunities for individuals to grow their assets. Financial markets perform important functions for the economy. 1. They provide a means for investors to buy and sell financial assets. 2. They facilitate the conversion of investments into cash. 3. They help institutions raise capital. 4. Financial markets help determine the fair prices of various securities. There are several types of financial markets: stock market, foreign exchange market, bond market, money market, capital market, commodity market, derivatives market. A capital market. A capital market is a financial market where buyers and sellers trade financial securities like stocks, bonds, and other long-term investments. It serves as a platform for companies, governments, and other organizations to raise money for long-term needs, such as building factories, roads, or expanding their business. Capital markets are typically divided into two parts. 1. Primary market. 2. Secondary market. Primary market. This is where companies or the government sell new shares or bonds for the first time to raise money. It's like a company launching a product for the first time. Investors buy directly from the company. Secondary market. This is where people buy and sell securities, like shares or bonds, that are already issued. It's like a second-hand market for stocks. Investors trade with each other. The company doesn't get money from these trades. Capital markets play a crucial role in economic development by channeling savings into productive investments and promoting efficient allocation of resources. Sri Lanka also introduced new types of bonds that change based on how well the economy and government are doing. In short, the Colombo Stock Exchange helps businesses grow and supports the country's economy by allowing long-term investments.
Money market.
Short-term financial instruments with maturities of 1 year or less are traded on Sri Lanka's money market. It facilitates the movement of short-term funds, which is essential for controlling liquidity in the economy. The domestic foreign exchange market, the treasury bill market, and the interbank call money market are the three primary parts of the Sri Lankan money market. Key features of the money market. Short-term lending and borrowing. It means financial instruments with maturities shorter than a year are traded on the money market. It makes short-term lending and borrowing easier, frequently to satisfy liquidity requirements. Low risk, low return. It means because of their short maturities and the creditworthiness of their issuers, money market instruments are regarded as low risk even though they typically offer lower returns than capital market instruments. Highly liquid instruments. It means treasury bills and call money are examples of highly liquid financial instruments that can be swiftly turned into cash with little loss in value. Examples of money market instruments. Treasury bills. It means government-issued short-term debt instruments. Commercial paper. It means companies' short-term debt. Certificates of deposit. It means bank-issued short-term deposit accounts. Repurchase agreements. It means contracts in which securities are sold with the intention of buying them back later.
Differences between capital market versus money market.
1. Meaning. The money market is for borrowing or lending money by individuals, companies, or governments for a short term, usually less than a year. The capital market is meant for making long-term investments. Funds are thus raised or invested for a period of more than 1 year, mostly through shares and bonds. 2. Nature of the market. The money market is informal with fewer rules than others. Transactions happen in a hurry, mostly between banks or financial institutions. On the contrary, the capital market is formal and heavily regulated to provide investor protection, meaning there lies a huge set of rules imposed by authorities that it has to adhere to. 3. Financial instruments. People in the money market mostly use T-bills, commercial papers, certificates of deposit, and trade credit. All are for short durations. Shares, debentures, bonds, retained earnings, and asset securitization are available in the capital market as instruments, which are for long-term funding. 4. Risk factor. The money market carries low risk because the investments are short-term and usually backed. 5. Institutions. Money market. There are the central banks, commercial banks, and other financial institutions like bill brokers. Under the capital market, commercial banks, stock exchanges, and insurance companies are listed. 6. Liquidity. The money market offers quick cash access and is best suited for short-term financing needs. As for the capital market, since long-term instruments are traded here, there may be some difficulty in turning an asset into hard cash within a shorter period. Summary of a capital market versus money market. The financial market consists of a system where individuals, corporations, and government agencies come to borrow, lend, or invest money. It is a giant system that channels money from those who have it in excess to those who need it for some reason. Depending on how long it will be needed, there are diverse components of this system. One part is the money market. Here money is needed for shorter periods, generally less than 1 year. Organizations and banks resort to the money market when funding is needed immediately for specific bills or daily expenses. The money market uses treasury bills and commercial papers. It's less formal, safe, and investments can easily be converted into cash at will. The other is the capital market. Here, money is raised or invested for the long term, buying land, buildings, machinery. When money is needed by companies and governments for major projects that take time to complete, this particular market is approached. Amongst others, it deals in shares, bonds, and debentures. It is more regulated and more formal, with a higher risk but offers higher returns. It's also not so easy to redeem your investment within a short period as these investments are comparatively longer. Money markets keep the engine running, while capital markets build the road ahead. Both drive the economy. Choose wisely where you invest. We hope you now have a better understanding of capital markets versus money markets. Thank you for watching this video.